Sorry for the technical difficulties. My name's Carolyn Fleury. I'm a financial advisor with Strategic Financial Partners. I'm here to talk about financial planning for when you want to start your business. Some of the key tips to get prepared. This is my colleague, Tyler Page, by the way. We work, as I said, for Strategic Financial Partners. I work with a lot of business owners, individuals, helping them plan for the future. We're going to talk about, so the key things in terms of getting started with your business is to make sure you get a plan in place, because you never want to quit your job if you have a current job and then start a business, because when you start your own business, there are a lot of expenses, a lot of risks to take on, and I'm here to help guide you through what I call the 52 mistakes that we can avoid before you leave your job and as you are planning to start your company. Basically, the advice for the incubation stage of things. And this is a disclosure that I have to say that I'm not a legal attorney. I'm not an accountant. So anything I give you, please, if it relates to that, you have to talk to your attorney or an accountant. I'm just here to educate. My whole mantra is knowledge is power. So before we dive in, let me talk about what financial well-being means. It basically means that you have to put everything in place in terms of what is in context. Having control over your day-to-day, month-to-month finances, having the capacity to absorb financial shock, being on track to meet your financial goals, and having the financial freedom to make the choices that also allow you to enjoy life. You all are not entrepreneurs and starting your business because you want to get into debt. You're here to pursue your dreams and make money. And that's what I'm here to talk about, the financial side of things. So we've loosely organized these mistakes based on definition. And we'll talk about money mistakes as they relate to 1, managing your finances, 2, financial setbacks, 3, meeting your financial goals, and finally, making financial decisions. Keep in mind, this is not a, one plan or one advice is not for everybody, depending upon, where you are in your business plan, where you are in your capital raising, where you are in your savings. Everything has to be, tweaked. So this is just not a one-time, don't take my advice and say, well, she said so. Everything has to be tweaked. Yeah, that's the rain. It's loud. It's raining here in Nashville, if anybody hears. So managing finances. Number 1, the first mistake a lot of people make is honestly not having a budget. And that relates to not only just your personal, but how you plan your business. If you are, just starting in the incubation stage, it's important to have a budget. Like, what are your expenses? What do you think your revenues are going to be? And we'll talk more about that in detail. Case in point, mistake number 2, spending more than you make. Until your business gets up and running, you should not be spending that money until you have the revenue coming in and you have the extra cash flow. The only way we can make sure we don't spend more is to have a budget and sticking by that budget. Misjudging, I know. What do you guys must have a tin roof here or something. So mistake number 5, misjudging big expenses. Let me give you a couple examples, like on a personal basis. Somebody buys a brand new car, and all of a sudden they're like, wow, my insurance has doubled now for my brand new car than versus the used one. You thought you bought the brand new car in cash, but all of a sudden you have all those other expenses that you weren't expecting, meaning a brand new car, the insurance is going to be a lot more. Oil changes, depending upon if you bought a European car, are going to be a lot more for getting your oil changed than it is for, your 15-year-old Ford. So all those little hidden mistakes goes back into the budgeting and planning process, making sure, you have that extra line item for what I call the what ifs. Not knowing the slow leaks, that's also very important with regards to building a business. All those little slow leaks, okay, if you don't have a place to make the copies or you're paying a little extra, it may seem like a small amount, $10, $15 here to go to Staples and get new business cards made. But all those little expenses can add up. And if you're not on track of it and you're like, oh, I'll hire somebody, yep, I'll get 100 business cards made for that new person. All those little small leaks can actually, what I say, that I'm a very visual person, make that basically leak turn into a huge explosion and can basically defund you if you're not careful of it. Mistake number 10, forgetting about those irregular expenses. That goes back to slow leaks, but also looking at your monthly bills and remembering, you know, some of these monthly bills we budget for, but we also forget to budget for the irregular bills. You may have, depending upon, you know, your monthly rent, if you work from home or if you have your own business space. But again, what are these other, maybe you get charged quarterly for your business insurance and your liability insurance. So you got to make sure you understand what those bills are. And what I like to do, honestly, is take those bills, either put it on an annual basis or make everything monthly, even if you're not writing the check or Venmoing on a monthly basis. So you are not having any surprises going on. I personally like to do everything annually, and then I spread it out. And then, you know, month February, I'm like, oh, I didn't have to pay my liability insurance. Oh, that's right. But that $25 is still in the account, and that's where it's going to get paid for next month. That makes sense. Mistake number 11. Oh, sorry, 13. Not paying attention to interest rates. This often goes hand in hand with not reviewing your monthly statements. As a business owner, you're probably going to have your, you know, separate business credit cards and accounts. And this is a good pointer even from a personal perspective. Make sure you review your monthly statements. Make sure you understand what those extra fees are. You know, I often recommend to my clients, ask if you can, you know, you've been with this credit card company for X years. Ask if you could get a lower rate. If you've got good enough credit, which I'll talk about in a little bit, maybe you can get a lower rate on your credit card. But definitely review your monthly statements, because you'd be surprised at how many extra fees they stick in there that you could, if you don't ask, you don't get. You can often get those waived depending on how long you've been with them. Let's see, okay. Number 17, not having enough of an emergency fund. This is so important when you're starting your business, because in your incubation stage, depending upon if you're still working and have a salary or not, you know, when you start your company and you are a business owner, you are going to have unexpected expenses, just like you do in life. There's no getting around that. Whether it's from changing new tires in your car, or, oh my gosh, I need a new computer, or your server went down, you have to have an emergency fund. Depending upon the size of your business, I recommend at least, you know, based on your projections, 3 months of what I call your run rate to have as an emergency fund. Unless you know, okay, you're getting by on one server, you're getting a second one, there's certain circumstances where we might be able to, you know, clarify that differently. But that is critical. Number 18, only having one source of income. If there's any chance that you or your spouse are starting a business, if one of you could keep working, I highly recommend that as a good transition base, so that at least you have some steady income coming in. Because unless you're starting it, you know, you still have your income. I've seen it's very hard to really launch a business without your full-time personal dedication. And usually, unless you're working 24/7, you're working another job. So unless you're going to quit that job or take a leave of absence, it's hard to get a business up and going and still make that regular paycheck from your former job. So little piece of advice, if you can have some sort of other steady income coming in, that's a huge benefit. Number 19, not understanding your employer benefits. This is huge. If you are still working for a company that's offering employee benefits, please make sure you understand what they are. Because when you leave that company to start your own, unless you're really, you know, have a lot of cash coming in, offering health care for yourself and for your staff can be expensive. So it's important to understand, you know, say you have in your mind, okay, I'm going to work 6 more months for this company. Look and see what their benefits are from a medical perspective. If you think you're going to have a root canal, if you're having some of those elective surgeries, you may want to do those before you leave that company, and take advantage of the benefits that are coming out of your paycheck and the health care that's being offered from that company that you currently work for. The other big thing I want to talk about is health savings accounts, or HSAs. If you have, who here works for a company already or right now? You're all independent? Okay. So before you ever leave a company, a lot of companies offer what's called HSA, Health Savings Accounts, meaning you can put money in and use it for the stuff that your health insurance does not pay. And actually, Tyler and I were talking about this. He actually just realized when I was going over this, he has an HSA he has not used. So HSAs are one of these things where you put money in and you never lose it. It's not like you use it or you lose it. So you could put money in 3 years ago and it carries with you from job to job to job to job. So if you had it from a previous employer and you never used it up, you got to look and see if you still have money there, because you can use it now to pay what's called qualified medical expenses. You can help pay for your deductible that you're paying out of pocket, or medication that you have to pay out of pocket. So my point is, if you are working for a company that's offering that right now, max it out. And that way, when you leave, you can take that with you. It's one more benefit to help you, use it as a crutch for when you start your own business and you are not getting that regular income. Little side note, people don't realize, if you never use that HSA, believe it or not, if you pass, it actually gets passed on to your beneficiary. So you will never lose it. It's always, it's going to be there but the key is to find it. So Tyler is now looking back at 2 previous employers and looking, because he's like, I think I had an HSA there. So number 20, carrying too much credit card debt. This is a big common mistake that people, it really starts the whole caterpillar roll of getting into too much debt. As you start your own business, you're like, oh, I'll put, the new tables, the new supplies on my credit card. That's great. But also then you have to think about, well, how are you going to pay that off? And I'll get into good debt versus bad debt in a second. All the more reason going back to having a budget, having the emergency fund, having the right capital to start your business. Because if you start putting everything when you start your business on a credit card, you're going to fail. Unless you have some brilliant idea and you're going to get cash flow immediately. This is a slippery slope to take. 21, this is about income protection. People don't realize you can actually, if you're buy income protection, and this has been very big for us recently during COVID, because if you have a financial setback and you have income protection, which basically is just, it's called disability insurance, you can fund almost up to 75% of your prior income. So say you are working for a company and you're making, I just worked with an interior designer last week. She works for herself, it's her own business. She makes about $100,000 a year, but her job is very physical because she's got to go to drive to people's houses, help advise, hanging chandeliers, designing, stuff like that. Her big thing was, what if I get in a car accident and I can't climb a ladder to adjust things, or even drive somewhere? So we got her disability insurance for about 70% of her income to help pay her mortgage, so that if she ever can't work for a certain period of time, she has that income replacement available for her, so she can still stay in her home and still pay her bills and her mortgage and stuff like that. So, that is part of the plan. I understand when you're starting a business, you're trying to cut back expenses, but if you are young and you're healthy and you start early enough, that's a very, very inexpensive piece of the puzzle to put into place. Number 22, not having enough life insurance. This mistake can lead to future financial struggles and lost opportunities, not just for you, but your loved ones down the road, and also your business partners. When you start hiring people, when you start businesses too, life insurance is a great way to help attract, retain, and reward employees. It's also a great thing, say you and your business partner have a business and you don't come home, you get killed in a car accident. Your wife, what is she going to do? Try to buy out your partner, or is she going to run the business? Maybe she knows nothing about that business. If she wants to buy the business, how is she going to pay for it? To buy, that person out, or to take it over herself? Life insurance is a great way to help fund that. We do a lot of what I call key man employee life insurance, where if, say, it's 2 business owners and they have a policy on each other, if one passes away, the other one, the death benefit goes to the other business owner. It's a great way to help fund the immediate expenses. If, say, you each have 2 different jobs, but you also bring in both 2 different sort of streams of revenue. If one person passes away, that life insurance can help basically be the crutch until you find somebody new, help supplement the income income replacement until you find that other person who come in and do that person's job to basically re-energize the stream of the income there. Number 23, you know, I know I'm from New York, so I talk fast, I apologize, but I always say, don't get too complex about your financial strategy when you're starting a business. Keep it simple. I think you all heard the acronym KISS, keep it simple. Same thing goes with financial planning. You know, if you don't need a PhD to do these things. If it gets too complex, you're creating too much work, you're creating too many fees, in my opinion, with lawyers and accountants. You don't need to have that much financial complexity to make a successful business work. This goes back to, some of these are basic, you know, do not make rush decisions as you are a business owner. Don't just do a knee-jerk reaction. Think about it. Talk to your peers. Talk to your center of influences. Figure out whatever the next step you're going to do is the right one for you. Yeah, my mother always said, nothing good ever happens after 10 o'clock at night. Same thing goes with making rush decisions, especially if it's a big one. Think about it. Don't rush into it. Number 25, this goes back to staying on track and having a budget, you know, not having financial goals. When you create a business, you need to have not just a budget, but a plan, your financial goals. Do you want to make $100,000 next year? Do you want to make $200,000? If you don't have a specific number in place, it's hard to have a budget. It's hard to execute. It's hard to know, are you keeping up with your plan and your goal? Number 26, not saving enough for the future as well. You know, many of us live paycheck to paycheck, which makes it hard to save. Going back to, if it's hard to save, how are you going to have that emergency fund to buy, say, the new server or the new computer that you need? And if you can't buy that new computer, is your business going to stall and not proceed forward? So again, not saving for the future is very important. Number 27, this might seem simple, but a lot of people do not do it, which is not automating savings. I'm a huge proponent of saying, you know, okay, you get your first paycheck of, say, it's $5,000. Put automatically, before you even see it, have an automatic, and you can set these up with your banks, whether it's a specific dollar amount or a percentage that goes automatically to your savings or into your mutual fund account. But out of sight, out of mind. If it sits in your checking account and you see it every time you put your debit card in, I've seen it happen. 90% of people say, oh, I got that. I can go buy myself, you know, XYZ. You know, you need to start that budget, the regimen of saving for the future. Number 28 is for people that are still with companies, not taking advantage of your employer's retirement account match. For those of you that do have matching where you have a 401k, I highly recommend putting in as much money as you can to match, because when you then leave the company and you want to start your own business, you can roll that money over into your own personal savings. Matching is basically free money. The way it works is, say you put $100 in, they match the same amount, you get another $100, boom, automatically. Day one, you've got then $200 in your savings. That is working for you for the future. So highly recommend matching whatever your account, your company does in terms of 401k matching. 29, only having a short-term outlook. So when it comes to finances, you need to have both long-term and short-term. And this ties back to the budgeting as well. You know, especially when you're starting out, I even recommend some businesses go, okay, let's go day to day to day for the first, you know, couple of months in terms of what does your short-term budget look like? What's the revenue going to look like? Usually it's more outflow of expenses, and then where's your revenue going to come in? But then again, back to financial goals, you need to have your long-term planning to help motivate you to say, okay, yeah, I might be putting out this much in the first couple of weeks, but my long-term goal is to make $100,000 net revenue per year for the first 3 years. And then I'm going to double my company by year 10. But do not please have that short-term outlook in your mind. Number 30, not changing with the times. This is very applicable to all of us these days. You know, in the last couple of months, we've been all changing with the times, going virtual, learning hopefully how to use the owl next time. You know, if you'd asked me 4 months ago, would I be doing seminars on Zoom? I do a lot of these, and you know, we've had them up. We've had audiences up to like 75 people. I'd be like, who's going to want to listen to me and watch my slideshow? But you've learned to go with the flow. So that's why I encourage people is, you know, you've got to learn how to change with the times, get more technical, whatever your business is, and whatever, you know, try to think outside the box of, you know, what if, you know, all those what ifs, and try to make your business plan, your financial plan, adapt to that as well. Number 31, paying the wrong debts first. Oftentimes people look at their largest debt, meaning, and usually it's their house mortgage, as something they want to pay off right away. Sometimes that largest debt is not the bad debt, it's actually the good debt. Especially if you're working from home, you can, you know, write off part of your mortgage, part of your expenses as your business expense. A lot of times, especially if you've refinanced recently, your mortgage debt is very low. What the bad debt is are the credit card payments. And that goes back to, don't start putting all your business expenses on credit cards, because those rates can be upward of 17%. Now I work with mortgage brokers a lot, because when I unpeel the onion, as I say, from a financial perspective, ask people what their, you know, all their financial questions. I'm like, oh, you got a mortgage rate, how much is it? 12%. I'm like, when was the last time you thought about refinancing? You should be under 4% right now, or around 4% from a mortgage rate if you do have a mortgage. So if you, yes, you might have to pay some fees, you can get those wrapped in, but make sure you understand what is in your personal situation, the wrong debt and the good debt, as I say. 32, prolonging debt repayment time. There are many reasons why someone may want to extend how long they carry a debt for, tax deductions being one of them. But often it puts people in the habit of saying, oh, I'm going to just pay the minimum each month, and I'm not going to pay off my debt. And that especially is particular with credit cards. Please do not just pay the minimum of debt of your credit cards, because what happens is your balance will just keep increasing because they're charging a northward of 15%. Borrowing from your retirement accounts. So as I talked before about, you know, try to match as much as possible your 401k if you're still working with the company. The great thing is a lot of people who are business owners then can start, you can borrow from your 401k, but you have to do it for the right reasons. Don't borrow from a 401k just to say buy your next Maserati or your new car. If you want to fund it for your business, that's a good way, because then you can use the interest rate to run it through your company. The problem is, though, if you don't have a plan to repay that loan back from your 401k, that's where you get into trouble, because one, over a certain period of time, it is considered taxable, and two, there are penalties associated with that. That's a whole nother seminar to talk about, but just my point is I want you to be warned about, understand the intricacies of borrowing from your retirement account. Number 34, not understanding your retirement costs. You're starting a business, that's great. But think about, you know, is it going to make $100,000? Is it going to make $200,000? What does your retirement look like? What do you want to live off of when you retire? Because that all ultimately goes into your financial goal in terms of how long do you want to own this company for? How are you going to get out? How are you going to live on? If you sell the company, what are you going to live on when you retire? You're going to have enough income to live off of. And that goes to number 35, you know, no distribution strategy in retirement. Entering retirement without a well thought out strategy of how you have the funds, where you're getting the funds, what does your lifestyle look like? I had one guy who's like, well, when I retire, I want to play golf 3 times a week. I was like, well, that's great. But you know, every time you go play golf, that's like 125, 150 bucks pop, depending on what golf course you go to. And that's probably more than you're spending right now, just your day-to-day expenses. So, you know, you be careful, think about, you know, do you want to travel? That's great. But traveling also is a lot of expenses, and thinking about, you know, how do you want to, what is your lifestyle and how are you going to fund that? Understanding Social Security, or I should say not understanding Social Security. Social Security was not designed to fund your retirement. It is there to help supplement it. If you actually look on the back of, you ever get a Social Security statement in the past, or you look online, there's actually disclosure that says this is not meant to fund your retirement. Honestly, who knows if it's even going to be around in 20, 30 years. You know, we have a lot of with everything going on with COVID and all the loans, you know, I have no idea. My opinion, I'm not counting on Social Security. So I just put that out there. Not being political, but just saying. 37, I think talking about your finances with your business partner or your family members or whoever is helping support you financially is critical. You know, you need to make sure you have a plan, because you're going to have some bumpy roads as you start your business. And if you're not clear, it can lead to a lot of bad decisions and anger and animosity. It can burn some bridges if you're looking for funding in the future. So please be candid about your finances. Number 38, there are a lot of people out there, including me, that you can get, you know, complimentary financial advice for. That's why I do these. My whole thing is knowledge is power. I love to educate people on sort of the what ifs out there. But you need to have, you know, legal advice, accounting advice, and financial advice when you start a company. And I know what I do well. Ask me an accounting question, I could probably opine, but I'm not an accountant. Just like you all, depending on what business you're starting, you know, it sounds great, but I would never even assume that I could do what you guys do. So get professional advice and go to the experts. And there are a lot of people out there like me that are happy to sit down and just brainstorm and give you complimentary advice. Number 39, again, not being knowledgeable about your finances. And number 40, waiting to get started. You know, there's another saying, the best time to plant a tree is 20 years ago. The second best time is today. This sentiment applies not only to your finances, but also starting a business too. You know, if you haven't started today, okay, start tomorrow, but don't wait. If you have the passion, the drive, you wouldn't be here if you didn't have that. You know, get started today. Number 41, credit scores, important in terms of if you do need to get a loan for your business. I can talk to you individually if you want to talk about how to get your credit score lower. That goes back to also not having balances on your credit card. There are lots of intricate things on that. But there are ways, you know, in 3-6 months, if you want to improve your credit score, I can certainly help you do that. And so that if you do need to get a loan, whether you're buying equipment, whatever it is, getting a loan from the bank to help supplement maybe payroll to get your bodies in for your company, that's a thing to think about too. 42. So this is sort of looking forward in terms of when you start having your successful business, not diversifying your assets and going back to savings. So once you start your business and you start having that money coming in, which I know you all will do, what are you going to do with that money? I hope you invest it and either put some of it back into your company, of course, but then put some of it into a diversified market, whether it's mutual funds, whether it's lots of different assets. I'm huge on diversification, because with all the volatility we have right now, we're going to have this again. You know, life goes in cycles. You look back at 08, 09, you know, 911, the market has just been up and down. Are we going to, you know, have we recovered pretty much? We're on the trend to it. Are we going to have another, you know, 08, 09 again 10 years from now? I guarantee you it. You know, you look historically, it just goes up and down. Now, in the long term, the slope of markets has been up in terms of financial markets, but it's good to diversify, because diversification helps you with weather the storms, so that if you do need to pull money out, say you had, you know, 70% of your money in stocks back in March, you would never want to pull out your money and sell stocks in a down market when it was at the all-time low. So what people had done in March, which was great, people like who had other pockets of money and they needed to pull money out or use it for leverage, they went to those other pockets of money. And now those, you know, those stocks are back up and they've regained the money again. Again, another topic I could talk about hours on. One little thing here, not having a will or estate plan as you start your own business and you start to make money. Regardless of whether you start a business, actually, you should all have a will or an estate plan. And I have several attorneys I'm happy to recommend to if you need somebody. Going to that, you know, depending upon assets you have, make sure your beneficiaries are up to date. You know, you might have said, oh, I wanted to have my, you know, brother who was my best friend many years ago, and now, you know, you're not speaking. So make sure your beneficiaries are up to date. 45, I talked a little bit about this before, paying down the minimum of credit cards. Don't do that. If you can pay a little more, especially credit cards are the bad debt. you keep high balances on your credit card, or if you keep, I got a question the other day, what if I max out my credit card and then I pay it back down? Well, that's not great. That hurts your credit score. What people with the credit, the way you get good credit is to not be more than basically 75% of your limit and then pay it back down. So you never want to bump all the way up to the full credit limit that you have. Once in a while, you could do that, but make sure you pay it back down. If you improve your credit score, you often will then get higher credit limits, which is great when you run a business as well to be able to borrow against it. But you want to kind of play that game of, if you have a credit card, again, no more than 75%, pay it back down, and keep that going. Number 46, I would say, keeping up with the Joneses. As you're starting your business, you got to be very aware of some of the expenses involved. Just because your neighbor, your brother, your sister has bought the new McMansion, don't try to keep up with, living out of your lifestyle. When you're starting a business, you got to be frugal. You got to keep your money and your, expenses low, because you're putting a lot of time and energy and finances into your new business. So do not spend too much on housing. Again, prioritizing your mortgage over other debt. We talked about that a little bit, good debt, bad debt. 48, this is, who here has kids? Anybody yet? No? Okay. I'll just say that in case anybody's on the phone. Prioritizing college funding over retirement. If you have children, you all want the best for them. You want them to get out of college without any debt. The problem is your kids can borrow money for college. They can get loans, they can get grants. You cannot get loans or grants for retirement. And again, Social Security, who knows if that's gonna be there. It's not gonna fund all your retirement. So if you had a choice, please do not take whatever capital you have, don't put it into your savings, and put it towards your college, your kids' college. That's a recipe for disaster, shall I say. So now the home stretch, last 4 common money mistakes. Not reading the fine print. Again, as you're starting your business, I encourage you all, whether it's if you're going to be leasing space, if you're going to be borrowing money, whatever it is, read the fine print. I can't tell you how many times I've had people come to me and they're like, even when they got a new credit card out, well, I didn't realize, it was 0 fee year 1 and they're 5 years in, and every year it goes up $25. Again, that's slow leak. May not seem like a lot, but they're like, I didn't realize it. And now they're paying $100 in fees for this credit card. They wanted nothing to do with it. And then there's like a $100 penalty if they cancel it. Believe it or not, I've seen it. So read the fine print in everything before you commit to anything. Again, 50, do not make decisions on emotions. Sleep on it. 51, lending to families and friends. Starting businesses, I can't tell you how many kids, or I said colleagues out of college. I went right and worked on Wall Street, and I had many of my college colleagues, I should say, I'm not quite sure they call them friends, were like, Carolyn, hey, I got this great idea, put $10,000 in. I did a couple things. None of them worked out, and unfortunately it hurt my relationships with them all, So, it's fine to ask your friends and family to help fund you. Just be careful and put everything in writing if you do. That's one thing I didn't do. They're like, oh, we'll pay you back. You're going to get 10% cumulative interest. Well, I got nothing out of that. So just be careful with that. And the last thing is a mother of 5, not teaching, when you have children, your children about money. My dad was, he gave us allowance every week. I was the youngest, and I would charge my brothers who would come to me to borrow money, and I would charge them almost like, I think it was like almost 75% like interest rate. I was like, okay, you want $5? You got to pay me back $8 tomorrow, $10 tomorrow. And my dad got wind of it one day, and he was like, Carolyn, that's great, but this is almost illegal. So he taught us, but I took it to the other level. So my point is, I think, finance is the basis of everything in terms of, you have to pay for whether it's your business, food, clothes, with money. Teach your kids about money, how to budget, how to manage it, because that is really the basis to success in terms of planning for the future. So that is, what I have here. Leaving a W-2 paying job can certainly be exciting, and it also can be very financially scary. I hope these points and some of these things sort of put a little light bulb off and help you along the way. And that's my contact information. It's on the flyer too, but if anybody has any questions, I'd be happy to answer them. Okay, yeah.
All right, I got a question sent in from someone asking about, in some ways, do you feel as though right now, we're doing business virtually because of the pandemic, it's made it like way cheaper than usual to start a business? Like, would you consider now actually a good time financially to start a business in some ways?
Absolutely, depending upon what the business is. Yeah, I mean, there's no overhead charge with, rent, and you don't have to drive and use your gas money. You don't have to buy anybody coffee or lunch. Absolutely. So now is a great time if you have put things in place. I even had one client of mine. He is a digital marketer, and his lease was up. He's got 6 employees. His lease was up right when COVID started. He asked his landlord, he's like, listen, I'm not quite sure. He was worried he wasn't going to make it. So he's like, I don't know. Can I get an extension on renewing the lease? Long story, about 2 months into COVID, he decided, he's like, we're doing this all virtually. We're making this company work virtually. I don't need the overhead of the rent. So he did not re-sign his lease, and now he doesn't have that nice expense. His company is taking off, and he's doing great.
Nice. I had another question sent in just about how a lot of the tips were centered around things like employee benefits, life insurance, credit, and obviously we had some young people in the room who haven't really built up these resources quite yet. That said, would you recommend that young professionals wait until they build like employee benefits and life insurance before starting a business? Or if not, are there other easy ways for them to safely start a business without already having those things in place?
That's a great question. Thank you. So it really, it's a case-by-case situation. If you have the great idea, now is the time, absolutely start. There are a couple of great ways that you can run some of these expenses, like paying for life insurance through your company and have a tax write-off too. So from an accounting perspective, there are a couple ways of doing it simultaneously as well. Some of these I say, the earlier you start, whether it's saving or putting a life insurance policy on yourself to help get, earn cash value through a whole life policy, it's never going to get as less expensive as it is today, because every year that you wait, it's going to get more expensive. Just like, if you start putting $50 into a mutual fund, right now, and you can make that sacrifice from a financial perspective versus waiting 3 years, $50 a month, you put it into right investments, you can start growing that nicely over time. So it's all about managing the, what your flows are and what your needs are. But if you have a great idea, I'm happy to sit down with all of you and try to figure that out and work through some numbers to say, okay, maybe we don't do $50 a month in savings. Maybe it's 25 to start building up that emergency fund. But let's see, if you have a great idea, I'd say go for it.
Nice. Another one chatted in about transitioning from from being a W-2 employee to being a business owner from a tax perspective. So the question is, do you have any advice for how to switch from having taxes automatically withheld to planning ahead for, being a business owner? Are there any rules of thumbs for estimated taxes? Do you know anything about this that you can share on?
Yeah, I can certainly opine. I'm not an accountant. So I would definitely, depending upon what your business is and how much revenue you're expected in, my guess is, from the companies I've helped, the first couple of years, you do not have to pay estimated taxes because honestly, you're not making that much money. You only have to pay estimated quarterly taxes when you are making above a certain amount of money. In terms of, going from a W-2, again, the questions I have asked back at, this person is, are you having employees? Because if you are paying employees, how are you paying them? Is it based on commission? Are you doing payroll taxes, taking it out and estimating for that? If you're not paying it day one, then you definitely need to have what I call a reserve account so that by the end of the year, you can fund those taxes. But again, if it's a startup, you might be able to write off a lot of expenses in terms of startup expenses and reduce the amount of taxes that you have to pay.
Mm-hmm. And then, Aaron, I don't know if you wanted to unmute yourself to kind of dig a little deeper into this question. It's just pretty broad about, if you think that there's any fundamental issues to consider just for long-term business planning. I feel like that is just really big. Aaron, I don't know if you want to get more specific of like anything that you're thinking about.
Yeah, can I be heard?
Yeah, I can hear you.
Perfect. Yeah, so I guess, in the current structure of the business, as my co-founders and I are getting started, we have a good feel for what we want to do for short-term planning and just thinking about streams of revenue and, just how long how much it would cost to do operations and things like that. But as far as the long-term planning aspect, thinking years ahead, we kind of don't have a good grasp of how to approach that yet.
Well, then I would say, just a thought of that is going back to it's important to have short-term plans and long-term plans. And when I said that, your plans are going to change because life happens.
Of course.
Business happens. So I encourage you to at least start with something. When I say long-term, maybe it's more like 3 to 5 years, but at least start with something and try to estimate at least. Are you going to hit it to the T? I doubt it. If you do, tell me your secret. But
Yeah.
you got to have something to at least shoot for, I guess is my point with saying long-term planning.
Gotcha. Okay. Yeah, just setting some goals and figuring out how that's achievable.
Hey, Carolyn.
Yes.
Hey there. So I'm working on a consumer app that really the revenue comes from first having users on the platform and then having businesses come in and then add sort of roll later on. How do I, if I don't see revenue in my plan for at least, 6 to 8 months, how do I sort of plan for that, right?
Great question. And that's where the coming into, making sure you have the emergency fund and enough cash on hand built in so that you can, feed yourself. And that's where I would start in a situation like that. Honestly, instead of maybe, do a month to month, but, almost do an annual plan to say, okay, it's going to take 6 to 8 months to get this income up and really focus on the year end, the 12 month, what does it look like in month 12 on you're going to have an incubation phase that's going to have no revenue. And then look at sort of your rate of return when you start making that income. Did that answer your question?
Yeah, it did. Thanks. And just to be clear, I'm more worried about feeding my dog than me, but yeah.
I hear you. My dog is the king of the house as well. I hear you. And that goes back to, little things, make that budget, need versus want. Do you really need to stop by Starbucks and go through the drive-through and pay for a $7 coffee and those slow leaks? Make the cup at home. And, I'm a big fan, and Tyler would agree. I bring my coffee I don't think I've stopped by a Starbucks and paid for coffee in years. I just don't see the need for paying, the $4 or $5 of Starbucks or whatever. I'm not rushing. I'm not trying to criticize Starbucks, but I'm frugal, and there's certain things you can be frugal with, and all those little pennies add up, and it helps you build your business and plan for the future.
Awesome. Are there any other questions? Feel free to chat in or just unmute yourself if you would like. I also don't know. Sorry, I had to leave the room because of our technical difficulties. If anyone in the room had questions, Carolyn.
Anybody have questions here?
I don't want to be greedy, but I've got another one.
Yeah, go ahead.
So just full disclosure, I actually quit my job about a month ago. Have been working full time, and I'm right now contemplating taking like a contract position. Mm-hmm. And because if I've got like 6 to 10 months of runway, but if I take that contract position, I could definitely just sort of indefiniteize my runway. You know, once I start making that contract money, if I decide to take it, should I just be putting all that into retirement, like a 401k, to just reduce my taxable income, or and you know, then keep burning off my savings of runway, or should I take that chunk, that lump sum of savings I've gotten, and try to do something else with it?
I honestly have to look at the numbers in detail. You know, the great thing about putting into since you're no longer with that company, it would be an IRA. Yeah, you are deferring the income, the taxes on the growth that you have until retirement. The problem is you could take a loan out on it, but it's not liquid money. So I would caution, you know, putting all that into a IRA. I would say, you know, let's look and see what other pockets of money you have. It might just be better off putting it into a mutual fund. Yes, you're going to pay taxes on the growth, but at least you have access to it and you have diversification. So there's some other things, you know, that's a tricky, I can't answer it in one sentence because it really depends on what you're going to need. If you're going to need the money in 3 years, you can certainly, you know, you can take money from your retirement for a first-time ownership or for major medical needs without a 10% penalty. But besides that, it's pretty strict on what you can pull the money out of. So I'd be cautious about putting all that extra into an IRA for liquidity reasons if you need it to feed your dog.
Thanks.
Awesome. Any other questions, folks?
Well, my name is up on the last slide.
I'm sorry, I had one more. I apologize.
Yeah, go ahead.
You gave an example of good debt earlier, being a mortgage. Do you have another couple of examples of just what we would categorize as good debt?
Yeah, you know, good debt, bottom line is if it has a good interest rate. You know, if you have, you know, a good business loan from your bank, if you have a low car payment, things that you are,
okay,
you know, using that are essential to your lifestyle, your house, your car. You know, if you run a manufacturing and you have you know, you've got some loans from the bank for your equipment, those are key pieces of you know, material that you need to live day to day. As long as those rates are low, those are good debt because you're using that. It's the debt of just, you know, frivolous spending and putting it on credit card and getting into that rat race of now you have 18% interest rate that's costing you more than you're making on the money that you have in the bank. That's the bad debt. Got it. It's sort of like my whole thinking of, you know, what's good savings, and I mean, savings are all good, but if you have $100,000 just sitting in your savings account at your bank, you're earning less than 1% on that. That's not a smart decision to have unless you're going to use it in 2 weeks. Even in 2 weeks, you might be able to, you know, do something else, but, you know, take some of that. If you need the liquidity, there are lots of different options out there. So on the income side, it goes the same way. You know, there are great ways to put money more long-term to make more out of, you know, make the money work for you versus just sitting it in your checking account and savings account. You know, I'm not saying put everything, you need to have liquidity, but you need to make sure that money works for you. Same thing, you may make sure that debt is in the right place and working for you the way it's supposed to be. You're leveraging your money.
Right. Okay. No, that totally makes sense. Thanks for explaining.
Awesome. Carolyn,
well, if anybody else has any more questions, feel free to, my email's up there, or call my office number. I'm happy to sit down. No questions too small. As I said, my whole mantra is knowledge is power. You know, if I can have a Zoom, if you need, you know, talk to me, I'm happy to sit down with each one of you and talk about it. As I said, you know, this is, I try to be general, but every situation in terms of starting a business is very different. And some of these may apply to you, some of them may not, but hopefully this gave you a little more insight and maybe let a couple light bulbs go off as to how to take the next step.
Awesome. Thank you so much, Carolyn and Strategic Financial Partners. I might shoot a follow-up email with a video link to everyone if you want to just like look back at anything, and also share Carolyn's contact information once again via email. But Thanks for tuning in. Thanks for dealing with me through those technical difficulties. Appreciate you all. All right, I'm going to sign us off. Bye, everyone.
Thank you. Bye.